everyone. It is October. Welcome back to another Cup of Joe. Very glad you're here. I'm Joe Gallimore, Director of Investment with Argent Bridge Advisors. A teammate of mine recently posed a simple question and turned out to be a loaded one. We were discussing 401k accounts, and she asked me, "Hey Joe, why not just put everything in one fund, say the S&P 500 index?" Now, the simple answer, of course, is diversification. And I'm sure that the concept of not putting all your eggs in one basket, it intuitively makes sense, right? But what does that mean for investing specifically? Diversification for what purpose? So that's what I want to talk about today. Now, the first reason diversification helps is because of risk. By spreading your investments across multiple strategies or sectors or asset classes, whatever, you ensure that you are not only exposed to a single one that tanks, stepping on the proverbial landmine, if you will. A good example of this were tech stocks back in 2002. Tech and growth stocks, they'd been doing well in previous years, but then that sector, that was down 35% in 2002. This compared to the S&P 500's 18%. It was down almost twice as much. Financials and real estate come to mind back in the great financial crisis in 2008. If you were heavy into dividend strategies at that time, dividend strategies have larger weightings to financials and real estate, so those suffered more. Just another good example. So again, investing in multiple things, not just in one or even a few very similar things, that helps limit the impact on your portfolio when we experience big downturns. All right, but enough about risk. Let's talk about returns. After all, stocks are positive in most years, especially when you extend the time frame. Your chances of being positive increase the farther out you go. So diversification helps capture returns. I'm going to share a chart, which I'm sure most of you are familiar with. This is from JP Morgan, and we reference it a lot. Now, this chart shows the year-by-year returns of various asset classes. And what you'll notice is that not a single asset class does the best every year. So by diversifying, you're casting a wider net, trying to capture the different asset classes that then become top performers, right? Now, some of you might just point to the far left column and say, all right, well, Joe, large caps did the best over this time period. Let's just pick those. What you don't see here is that if you go beyond just this 14-year time period, small caps and even mid caps actually outperform large caps. So what's the single best asset class? Well, depends on your time frame, right? Then let's consider what current conditions are like today. What's most favorable in today's investing environment? For instance, right now, many strategists think that international stocks are cheaper than US stocks. So you could see a pop in performance there. So let's go into those. All right, well, how long is that going to last? You get my point. So all these factors are considered when deciding which fund to pick. And diversification just helps you capture all the best performers. And before we leave this chart, I want to point out this white box in the middle. These white squares represent a diversified portfolio. Now, as you can see, these white boxes move steadily along the middle, which translates to a smoother ride as your account grows. Now, if you're tempted to try and pick the winner each year, be warned. There is a lot of science behind the human tendency to chase returns. And chasing returns is when you go into buying what's already done well. Problem there is that this tends to lead to poor performance because you're inherently buying at higher prices, right? This idea is the origin of Warren Buffett's famous quote, be greedy when others are fearful, and be fearful when others are greedy. So trying to successfully hop between single asset classes is a good way to set yourself up for disappointment. Now, those are the technical ways diversification helps, but there's also a whole other function that diversification serves, And this role is a mental one. To frame this idea, I'm going to offer you an analogy that investing is like exercise. It's essentially a necessity for your long-term well-being. But if the activity itself is stressful or frustrating or even negative, you're less inclined to do it, right? So diversification helps with this. It's going to help improve your experience along the way. And this not only increases your chances that you actually accomplish it, it can also make it more rewarding, which is a good thing. So the first way diversification does this, it acts as an emotional regulator. By spreading out performance risk, you save yourselves from the effect of highs and lows that can add a lot of unnecessary stress and anxiety to your daily life and investing experience. Diversification also fends off feelings of strong FOMO. And FOMO, which is the fear of missing out, I think that's something we're all guilty of at some point or another. But when you own just one thing and you see something else do better, you're not going to want that. So the problem with FOMO is that it's a never-ending cycle, and you're probably likely very seldomly happy with the results because you're always going to want something else. So diversification works against that effect. Now, the second way diversification plays a mental role is by framing your mindset or your approach to your portfolio. One thing we've seen be helpful to clients is compartmentalizing. That's taking the different components of your diversified portfolio and thinking about each one differently. For instance, you can do this based on time frame. You can look at it and say, all right, 30% of my portfolio is in bonds. That's money I'm going to need for the next 5 years. Bonds are safer. The other 70% invested in stocks, that's money I'm going to need farther down the road, say for 10 years or longer. Another way you can compartmentalize is by saying, based on risk, you can say, all right, 40% of my portfolio is in bonds. That's only expected to fluctuate, say, 3 to 7%. I can handle that. So it's okay if the other 60%, which is invested in stocks, it's okay if that fluctuates more, because I know there's higher upside potential there, and I've assigned a longer time frame to that money. So these are a few ways that diversification helps you digest the risk involved, and it helps you manage the seemingly endless, disappointing task of managing the track meet of asset class returns, right? All right, so back to the beginning. The next time you're looking over your 401k and you're tempted to pile everything into one fund, I hope that a few of the points we've discussed here today, I hope it resonates with you and helps make that decision a little easier. Or you can just give us a call. We'll talk about it. That's it for this month's Cup of Joe. Thank you everyone for watching, and we will see you in November.